Hello, this is the 25th episode of What Would Peter Lynch Do, which explores the wisdom of legendary investor Peter Lynch. Welcome to the deep dive. Today we're diving into, well, a really interesting question about a company I think pretty much everyone knows, Disney. And this deep dive, it's actually directly inspired by you, by an insightful observation one of our listeners made. You pointed out that Disney stocks, they had that rise during the early COVID times, but then they were sluggish for quite a while. And now maybe, just maybe, they're showing some signs of life again. And you asked this brilliant question. Peter Lynch himself, way back like 40 years ago in One Up on Wall Street, used Disney as an example of a turnaround stock. So the big question for today is, can we expect a turnaround from Disney this time?
Mm-hmm.
So our mission today is to unpack Peter Lynch's idea of turnaround stocks using Disney both historically and right now. We'll dig into recent research, look at the data, and see if the past gives us any clues for what's happening now.
Yeah, it's fascinating, isn't it? How understanding the story behind a company, just like Peter Lynch always talked about, becomes so important, especially when you're looking at a potential recovery. The story of why things went wrong, and maybe even more critical, how they plan to fix it. That's really the heart of it.
Okay, so let's unpack that.
Mm.
What exactly did Peter Lynch mean by a turnaround stock? For maybe listeners newer to investing, he saw these as, well, really attractive opportunities, right? Potential for big returns.
That's right. Peter Lynch basically defined turnaround stocks as companies that were in pretty serious trouble, maybe even, close to bankruptcy. But now they're showing clear signs they're recovering or they have solid plans they're actually acting on to improve. And for Lynch, the story was everything. There has to be this clear narrative. Why did the company get into trouble? What went wrong? And crucially, how are they going to fix it? It's not just about being down. It's about having a believable path back up.
And Disney, back in the day, was a perfect example for him, wasn't it? Like in the
Yeah.
80s. They had struggles with the animation division, which used to be their core, and management wasn't exactly firing on all cylinders. Things were drifting. But then came the turnaround. New management showed up, reorganized animation, invested heavily in the theme parks, and boom, huge growth. The company came roaring back.
Absolutely. And Peter Lynch's point was that these companies, while they're recovering from the brink, could generate enormous returns precisely because most investors had written them off. They were overlooked.
So if we boil it down, what are the key characteristics of turnaround stocks, according to Peter Lynch? First, you mentioned it, investors neglect. Everyone's negative or just not interested.
Right, which leads to undervaluation, big time.
Okay.
Second, a clear cause of difficulty and solution.
Yeah.
You need to know why they stumbled, a bad product, poor management, whatever, but just as important, there have to be concrete plans, and you need to see them being executed to fix that specific problem.
Got it. And third, financial structure improvement. Things like cutting debt, selling off non-core stuff, saving costs, getting the books in better shape.
Exactly, shoring up the foundation. And often tied to that is new management or strategy. A fresh pair of eyes, maybe a whole new leadership team can be the real catalyst.
Makes sense. New blood.
Yep. And finally, sometimes you see a successful product or service launch. Doesn't always happen, but a big hit can definitely accelerate things, prove the turnaround is real.
Okay, let's jump forward. Disney's recent journey. As you pointed out, listener, it's been bumpy since that initial COVID boost faded.
Yeah, it really has. And the causes for these recent difficulties are pretty clear, too. First, those massive investments in streaming, Disney Plus outperforms huge spending, but profitability took a long time to show up, big losses piling up. Then you had declining profits in the traditional media side, cable channels, networks as people cut cords, and of course, the theme parks took a huge hit during the pandemic lockdowns, fewer visitors. Plus, some of their newer content, well, it just didn't perform as strongly as hoped. Bit sluggish.
Right. Which brings us to the Bob Chapek era. That was, 2020 to late 2022? He came in right when the pandemic hit and really doubled down on those streaming investments.
He did. And during his time, several issues really came to the forefront and seemed to weigh on the stock price. First, as we said, massive losses in streaming. Subscribers were growing, sure, but the cost of content, especially originals, was just astronomical, a huge financial drain. Second, there was a deepening PC controversy. Now, this is tricky, but reports and criticisms grew that some felt Disney's content was becoming overly focused on political correctness. The argument from critics was that this sometimes distorted original stories or didn't resonate broadly, pointing to examples like debates around the live-action Little Mermaid or Snow White. And then there was that very public conflict with Florida over the Don't Say Gay bill, which created significant backlash and public relations headaches for the company. And finally, there were reports filtering out about internal discord and management confusion, talk about friction between Iger and Chapek, maybe some confusing restructuring efforts. All that created uncertainty. And it all culminated in Bob Chapek's pretty abrupt dismissal in November 2022. And surprise, surprise, Bob Iger came back.
Okay, so Bob Iger's back. The new management piece of the Lynch puzzle seems to be there. What does this mean now? Is this the turnaround story unfolding?
Well, it's really interesting when you look at it through that Peter Lynch lens right now. Disney seems to tick a lot of the boxes.
Yeah.
You've got the clear cause of difficulty, streaming costs, legacy media decline. We know that. But now, crucially, you're seeing concrete solutions and execution. They're actively working on streaming profitability, they're cutting costs significantly, restructuring core parts of the business, and maybe just as importantly, you see the shift in investor sentiment. People were pretty down on the stock, but that's starting to turn. You can see it in the price movement lately.
Right. And the numbers, Peter Lynch always said, the story needs the numbers to back it up. So let's talk numbers. That streaming business turnaround to profit. How big a deal is that?
Oh, it's huge. I mean, psychologically and financially, for years, streaming was just bleeding cash. Billions. Then, in their Q3 for fiscal 24, that's April to June, the combined streaming business actually posted a profit, about $47 million. Now, compare that to a $512 million loss the year before. Massive swing. And it wasn't a one-off. Q4 24, July to September, profit was $321 million. And get this, they hit profitability a whole quarter earlier than they guided for. That tells you the pricing changes, the content strategy adjustments, they're working. It shows the main growth engine can make money.
Wow. Okay. That directly tackles a huge investor concern. What about the large-scale cost reduction? You mentioned that earlier.
Yes, they set a big target, over $7.5 billion in savings, and they're acting on it. There was significant restructuring, layoffs of over 7,000 people starting in 2023. They're really focused on making content spending more efficient and cutting expenses in those declining legacy media businesses. These aren't just surface cuts. They're aiming for real structural changes to boost efficiency and profit margins.
And all this time, the theme parks, the experiences segment, that's been the reliable workhorse, right? The cash cow.
Absolutely. It's been incredibly strong, especially post-pandemic. In their latest quarter, Q1 fiscal 25, October to December 24, experiences revenue was up 9%, operating income up 13%. That's more people visiting, yes, but also smart price increases in the cruise business growing too. Back in 2022, the operating margin for parks was already super high, like 27.5%. So it's this incredibly profitable base that kind of helped fund the streaming push and provided a safety net.
So streaming, turning profitable, serious cost cuts, parks booming, it all leads to an upward revision of their overall financial outlook. Yeah. What's that signal?
Exactly. They bumped up their guidance for fiscal 2025 adjusted earnings per share, EPS, now expecting a 16% increase compared to fiscal 24, which is way better than the high single-digit growth they previously mentioned. And they're targeting around $15 billion in operating cash flow for fiscal 25. It basically signals management's confidence. They're telling the market, look, this turnaround is real, it's sustainable, and it's hitting the bottom line.
That's a compelling narrative, backed by some solid numbers. Peter Lynch would definitely want to see that connection. But is it completely smooth sailing from here, especially with streaming? Is the profitability sustainable?
That is the million-dollar question, isn't it? And Lynch would absolutely hammer on that the numbers must support the story. The streaming profit is dramatic, no doubt. It changes the narrative from potential to actual profit, which is huge for confidence. The cost cuts, they're foundational. They show structural discipline, not just a temporary fix. And the parks, yeah, that reliable cash flow is a safety net showing the strength of Disney's diversification. So the data really suggests this isn't just a slight bounce back from being down. It looks more like a genuine structural improvement, a strategic shift. But, the media world changes fast. Sustainability is always the key challenge.
Okay, so the financials are improving. Let's talk leadership again. Bob Iger's return seems pivotal. His track record is obviously stellar: Pixar, Marvel, Lucasfilm, launching Disney Plus in the first place.
Absolutely. And interestingly, when he came back, he made what seemed like a very deliberate change in stance on that PC controversy issue. He was quoted saying things like, "Disney creators have forgotten what their top priority is." And significantly, while conveying positive messages is important, it should not be the top priority. That was widely interpreted as a signal, right? stressing storytelling entertainment, broad audience enjoyment first, maybe moving away from a perceived message-first approach that had drawn some criticism. The focus now seems squarely back on entertainment and universality, trying to win back audiences and boost performance.
So Iger's steering the ship now, extended his contract to 2026 to manage the succession. This raises an important question. Who takes over after him?
Yeah, the succession question is huge. As of late 2024, the focus seems to be on key internal candidates. There's Josh DeMauro, runs parks, experiences and products, great track record there, crucial operational skills for the cash cow. Then Dana Walden, co-chair of Disney Entertainment. She oversees TV and streaming content, so deep understanding of that crucial digital future. You've got Jimmy Pitaro, chairman of ESPN. Sports is a massive changing piece of the puzzle. His media expertise is vital. And Alan Bergman, co-chair of Disney Studios. He's a movie guy, knows how to make those big box office hits that fuel everything else. Whoever gets the job, they've got a tough balancing act. They need to keep that streaming business profitable and growing. That's hard. They need to keep restoring the entertainment value and broad appeal of the content, making hits people love, plus figuring out the future of legacy media like ESPN and ABC. Still valuable, but challenging. And keeping the whole massive organization running efficiently, innovating. It's a huge job. They need to respect Disney's core storytelling DNA, but also navigate this incredibly dynamic market. Building on Iger's turnaround work, can Disney truly resurge long term? That's the big question mark.
What a journey. It really is fascinating to see it through Peter Lynch's turnaround framework. It really brings his ideas to life. And, let's say a word from Lynch today and say that this principle is connected not only to investment decisions, but also to life wisdom. Peter Lynch taught us to understand the story behind a company, but always check that it's backed up by the numbers. What if we applied that thinking more broadly, like to our own lives? Could we identify our own clear cause of difficulty, maybe find our own new management, like a shift in mindset or approach, and look for the financial improvements, maybe healthier habits, better decisions, focusing energy wisely, the tangible signs that things are actually turning around for us? It's really about seeing the narrative of change, but also needing those real, measurable signs of progress, whether it's a stock or, something else entirely. Food for thought. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.